Welcome back to Investing Talk Podcast.
Today we're looking at WULF.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We're dissecting a really fascinating story today.
Right. One with a lot of layers.
It's centered on extreme growth acceleration paired with a really compelling competitive moat in the Bitcoin mining space.
Okay, so let's cut straight to the numbers, the ones that, initially grab everyone's attention.
Absolutely. The revenue growth for this company has been exceptional.
But it's the future projection that's really the headline, isn't it?
It's that hockey stick trajectory. Analysts are looking for revenue of about $197.5 million for 2025.
Which is a solid 41% year-over-year jump. That's already impressive.
It is. But here's the critical pivot point. For 2026, revenue is forecast to more than double that figure. Projected to hit $431.2 million. That's a jaw-dropping 118% year-over-year increase.
That kind of hyper growth, it suggests a massive infrastructure expansion. And that operational leverage is really starting to kick in.
It does.
But we have to address the core tension right away. Massive growth often comes at a price.
Of course.
And right now, they're not really profitable. I mean, the consensus EPS for 2025 is sitting around negative 34 cents.
Exactly. And that's the necessary friction we need to explore. Management's thesis and, what analysts are buying into is that this loss is purely a function of aggressive scaling.
So they're spending money to make money, basically.
Precisely. They're taking on high upfront costs to build out their mining capacity, which is expected to translate into much, much wider margins down the line.
That's classic operating leverage in action.
Right. Fixed costs, like data center construction, are deployed fast. And then as the infrastructure fills with miners, the revenue just rapidly outpaces the cost growth.
It's the classic growth stock dilemma, isn't it? You take the pain now for the compounding returns later.
It is.
But you need the balance sheet strength to stomach that kind of pain. How do they look on that front?
Well, for a company in this sector, which is inherently volatile, their financial stability is surprisingly sound.
Really?
Yeah. Based on Q2 2025 data, they have moderate financial leverage for a miner expanding this fast. We're talking a debt-to-assets ratio around 0.35.
That's manageable. But in a sector where Bitcoin's price can just change your entire cash flow in a single quarter, that cash pile becomes critical.
It's the defense mechanism. And they reported robust cash reserves, about $49.6 million in Q2. That liquidity is crucial.
It funds the expansion and gives them that buffer.
Exactly. It's the buffer against the volatility of the asset they're mining.
Okay, so let's unpack their competitive moat. Because the numbers are great, but the why is always more interesting. Why them?
The differentiator is their vertical integration combined with their energy procurement strategies.
They control everything.
They're one of the largest vertically integrated, fully self-mining public Bitcoin miners in North America. And this control lets them implement what is, I think, the most powerful moat in the industry today.
Which is their low-cost, zero-carbon energy.
That's it.
So what does that mean in practical terms? Are they just buying carbon credits?
No, and that's the key point. This isn't just window dressing. They've established a proprietary low-cost energy model.
Wow.
They're using direct access to cheap zero-carbon power sources, think hydro, nuclear, at their Lake Mariner and Nautilus facilities.
So this isn't just buying offsets.
No, this is sourcing guaranteed, clean, often stranded power. The result, they get some of the absolute lowest power costs in the entire sector.
Which translates directly into higher profit margins per Bitcoin mined. It doesn't matter what the price is, their margin is just better.
Exactly. Compared to competitors paying standard industrial rates, it's a huge advantage.
And that low carbon status, that just checks the big ESG box.
It really does. It positions them perfectly for the growing ESG-compliant investment mandates.
Right. Institutional money has to filter for this stuff now.
And this company isn't just scalable, thanks to their modular build-outs. They're scalable in a way that is really attractive to large patient capital.
Okay, so fundamentals look great, all driven by this unique energy cost advantage. But how's the market actually reacting to this story? Let's turn to the technicals.
The market reaction has been, well, explosive.
Give me a number.
Here's a fact that's going to appeal directly to momentum traders. The stock is up over 500% from its 52-week low of about $2 to a recent high of over 17.
Wow. A 500% run in a year is massive.
Yeah.
But how much volatility are you signing up for with a name like this?
Significant volatility, which, is expected for crypto equity. We're seeing a beta of 4.31.
Okay, put that in context for people.
A beta of 1 means the stock moves with the market. A beta of over 4 means if the market, or more likely Bitcoin itself, moves up or down 1%, this stock could move over 4% in the same direction.
So it's highly leveraged. That's where the upside comes from, but it's also the main risk.
Absolutely. And right now, even after that 500% run, the stock's consolidating. It's trading between, say, $11.88 and $13.89.
That $2 range is actually pretty tight for a stock with that kind of beta. It suggests the market is sort of pausing before the next big move.
Precisely. The bulls are accumulating at the technical support level around $11, while you've got resistance sitting strongly between $15 and $17.
So a break above $17 on high volume would be a big signal.
A very strong continuation signal, probably triggered by a catalyst.
And speaking of catalysts, the analyst sentiment is already there, right? We're seeing a strong buy consensus.
It's nearly unanimous, 12 out of 13 analysts covering the stock.
And what about price targets?
The consensus is in that $16 to $18 range, but you have top-tier targets from firms like Rosenblatt, Needham, Citizens. They're stretching as high as $22 to $24.
And these upgrades are happening for a reason.
They are. They're following recent confirmations of strong operational execution.
So let's outline the near-term drivers. What could move the needle in the next, say, 3 months?
You have both hard catalysts and some speculative drivers. The high retail interest is one thing. It's a top discussed stock on social platforms.
Because of the leverage to Bitcoin.
Right. But critically, we're also seeing institutional validation. Hedge fund and institutional positions have been increasing over the past quarter.
Okay, what about scheduled events? What's on the calendar?
The first big one is the Q3 2025 10Q and earnings release. That's expected around November 10th.
And the market will be watching for.
Continued hash rate expansion and accelerated revenue growth. If they deliver, that tends to trigger an immediate stock re-rating.
Beyond that, you've just got the industry-wide catalysts.
Yeah, more spot Bitcoin ETF flows or just a renewed crypto rally. If the price of Bitcoin moves, their margins expand exponentially.
And there's an often overlooked institutional driver, the index rebalancing. We need to keep an eye on the December 16th decision.
Absolutely. If their market cap and liquidity lead to an increased weighting in key indexes, well, that mandates institutional funds to buy the stock.
Forcing new institutional flows.
Significant new flows.
Okay, we have to talk about the speculative buzz. What are the unconfirmed rumors floating around?
So there are rumors circulating, and we have to stress these are unconfirmed, about potential new high-profile hosting customers.
So beyond their own self-mining.
Exactly. And there's also speculation about new mining sites, maybe in Texas. If either of those rumors gets validated, it would fuel rapid upside.
But again, rumors are speculation, not investment advice.
Always.
All right, let's turn the coin over. We have to address the risk profile. You can't have this kind of growth story without some inherent dangers.
Of course not. And the primary risk, which, dictates almost everything else, is its extreme exposure to Bitcoin's price volatility.
That 4.31 beta.
It's a double-edged sword. Their profits are highly sensitive to BTC price swings. If Bitcoin pulls back, those 500% gains can evaporate very, very quickly.
And then there's the second risk, which is just execution. They're trying to grow 118%. That's moving at hyperspeed.
Correct. Scaling up that fast, building the centers, installing the machines, it always carries operational risk. Management has a strong track record so far, but execution risk is inherent in a story like this.
Delays or downtime could hit that 2026 forecast hard.
Severely. And the third major vulnerability, it's their entire competitive advantage.
The energy procurement.
That's it. Their reliance on a cheap, steady supply of zero-carbon energy is a huge advantage, but also a risk if something changes. Regulatory shifts, infrastructure problems.
If that low-cost power source goes away.
Their industry-leading cost basis erodes, and so does their entire competitive moat.
Okay, so let's synthesize all of this. We have stunning growth, a proprietary zero-carbon moat, high analyst conviction, all set against extreme volatility and execution risk. What's the final thesis?
Our overall bullish view holds strong. TeraWulf is executing a very aggressive, very efficient expansion. It's supported by top-tier revenue growth projections and that huge cost advantage.
The valuation is aggressive, but warranted if they hit their targets.
Exactly. What this all means is that their focus on being a zero-carbon, low-cost producer really positions them uniquely. They can capture the high-growth phase of the mining sector while also appealing to institutional investors who need that ESG compliance.
So it makes them suitable for both short-term momentum trades
Yeah,
and maybe as a longer-term multi-year play.
I think so. You can trade the catalysts, or you can invest in that growing competitive edge for the long haul.